arena as well.
Yeah, good. Good to hear it.
All right, so it is 12:01, so we'll get started. If others join in, that'll be great. I'd like to introduce our special guest for today, Mr. Richard Stewart, and he is the enthusiastic reverse mortgage specialist for our division of cross country mortgage. So when you have clients who are in need of a reverse mortgage or you have more questions, you can reach out to me and then I can start the process of working with Mr. Stewart. So we're always still a part of the transaction in order to be there and help with the communication piece. But we have Mr. Stewart to be our direct reverse mortgage specialist. And this is all he does all day long, 24 hours a day. How many hours you work, Mr. Stewart?
24/7, of course.
24/7. Just like everybody else.
If you've got a loan for me, I'm available 24/7. If it's a dumb question, it's like 8 to 9, 8 to
There
5.
you go. Don't call me with no wolf ones. All right, gotcha. Well, I'm going to turn the floor over to you. We've had a couple of other people join. So thank you, Ms. Jerica, and thank you, Mr. Mance, for joining. We're going to get started.
Fantastic.
Yes, sir. Do you
So
want
do you
to?
want to give me the screen?
Yes, sir. Miss Larissa, can you turn it on for him?
It has you as the host.
What's that?
Tamika's about to turn on the share screen for you.
I got.
Here we go.
I tried to get my handy dandy notebook so I can get smart. I'm ready.
There I am. Okay, we're good. So hang on a sec. Stop share. All right. So before I share the screen, as Tomeka said, my name is Richard Stewart. What cross country mortgage figured out a couple of years ago is that reverse mortgages are kind of a completely different animal. You know, they have a lot of moving parts, and even though it's called a mortgage, sometimes the only thing we have in common is when at the end of the process we're putting a lien against the home. So they created a division called Reverse One, and they headhunted people like myself and other people who have done nothing but reverses for a long, long time. Like I have only funded reverse mortgages for the last 10 years, even though I've been in the reverse mortgage business for longer than I want to admit, probably longer than any of you have been alive. I started in the early 90s and just did some research, had a flash one day and thought I better start specializing in these things. The same flash that Cross Country Mortgage had. So the neat thing about our division is not only are the loan officers all reverse mortgage experts, so's the entire department, which is important. So we don't even have anybody in the Reverse One team who isn't a career reverse mortgage person. So essentially, Tomeka and I have been assigned to each other. So from your perspective, I've got a desk in Tomeka's office. It's just a pretend one, a video one. But as soon as you guys come across a reverse mortgage or someone who's just mildly interested in one, then Tomeka and I will introduce ourselves, and essentially I'll put the deal into the Reverse One team, and then away we go. So what I'm going to teach you today is I'm going to give you a bit of an overview of reverse mortgages, but since I'm assuming most of you are either realtors or you're loan officers, so I'm going to explain to you how you can use reverse mortgages to sell more homes with higher commissions. And I always dangle that out there nice and early, hoping that you'll listen to me when I explain to you that. And I'm as serious as a heart attack. Reverse mortgages can seriously help you sell more homes with higher commissions. So already you've probably noticed that I have a southern accent. It's just a little bit further south than you guys. I grew up in New Zealand, of all places, but I came out to New Zealand in 1991, and I'm still here. I came out here chasing a woman. I planned to go back to New Zealand with her, and that was 33 years and 3 kids ago. Still together, so it was a good move. All righty, enough of that. So what I'm going to do is pull my presentation over here. I'm going to go through some of the slides quite quickly, and I'm going to stop on the slides that I believe are important. All righty. So let's hope this works. All right, everyone can see that? Oh, hang on a minute.
Yes, sir, I can see it.
All right, so the new reverse mortgage should be up on your screen. Is that what you're all seeing?
Yes, sir.
Okay. So I'm going to quickly move on. So every single day in your backyard, you've got not in your backyard, nationally, we've got 10,000 Americans are turning 62 every day. So that means 10,000, that's 20,000 hips, 20,000 knees. And so their needs are changing, right? And the reverse mortgage can help with that as people become more and more attuned to what a reverse mortgage is. Like, we're living in a time now that is completely different to what it was. Like, I've just put some points there for us to go back and have a look at. And importantly, back in 1970, only 1 out of 265-year-old women was expected to live to 100. And now, if you're a healthy 65-year-old woman, you have a 11% chance of getting to 100 or beyond. So the point I'm making is that people are living longer, which is great news if you're healthy and you've got enough money, right? We've all had periods, well, let me use I statements, but I've had periods of my life where money's been, hasn't been a problem, and I've had periods of my life where money's been a major pain in the butt. And the pain in the butt period was definitely less enjoyable than the not worrying about money period. So a lot of these people, even though they're living a long, long time, if they're waiting from Social Security check to Social Security check, they talk about the golden years, but there's not a lot of gold in the golden years if you don't have enough gold. I should make a poster out of that. So there's been a paradigm shift in thinking, and that's my big word for the day. But typically, we used to look at 3 different buckets of wealth, and that is people's income, their investments, and other insurances is short for investment portfolios, but mainly income. Now, if you're retired or about to retire, the bulk of your income is going to come from investment vehicles that you paid into for your entire life. And I'm talking about Social Security. Some people, not everybody, are lucky enough to have paid into a 401k account. But for the most part, a lot of people have not put enough. Whoa, that's dangerous. Hang on. There we go. Have not put enough money away for retirement, but their entire life they've paid into a Social Security. They've paid into a 401k. They may even have their own investment portfolio. And what's the other thing they've paid into for their entire life? And that is their house. But up until recently, people, my dad was a World War II generation guy, God bless him, but their whole focus in those days was to get the mortgage paid so you wouldn't have a monthly payment. Well, not having a monthly payment certainly helps with retirement, but the fact that you've got all that equity in the house is not really an integral part of your retirement plan if it's just sitting there in equity. So and just one little graph here, if you look at the age group that has the most amount of money is the 65 to 69-year-old group. But that blue figure up there, which is now up over 200,000, represents their net worth. But if you take away the net worth in the house, now you're down to the red one. And the average net worth, taking away the housing equity for people 65 to 69, is only around $50,000. So my point is, seniors are holding trillions and trillions of dollars in equity, but most of it's been held in their house. All right. So what are their options? Well, their option really is to do a home equity loan, these are the common options. Problem with a home equity loan is, first of all, they're very difficult to qualify for. And secondly, it involves a monthly payment. Now, don't forget, in my demographic, cash flow is king. All right. They're not coming to Tomekia. A 74-year-old is not going to come to Tomekia and say, hey, I want to buy an apartment building. And what I'm going to do is have the tenants pay the mortgage so that one day I'll own the apartment building free and clear. Well, one day will be when a 72-year-old is 102. The point I'm making is that's not their strategy anymore. Their strategy is, do I have plenty of money month to month to enjoy my retirement? The other option is to sell their house and take out all the equity. Here's the problem. You still have to live somewhere. I have a solution for that, and we're going to get onto that real soon. But equity loans also, the bank has a lot of control over a home equity loan. During the pandemic, they recast a lot of HELOCs. And by recast, I mean they stopped how much they could take and made them start to make curtailments. In other words, they had to make payments. So now just another drag on your monthly cash flow, right? All right. So this is important. There's no point even talking about reverses today unless we all understand the myths and why they are myths. So the most common myth, and the one I hear every single day, is I would love to do a reverse mortgage, Rich. I love the idea of being able to get $200,000 tax-free out of my house, but I don't want you guys to own my home. And what I tell them is, well, that's great news because we don't want to own your home. Like, we're lenders. We're not real estate people. So what I'll do, just like Tomekia does with her mortgages, I'm going to loan you some money. I'm going to put a lien on title. So in other words, I have to get paid one day when the home is sold, but we don't go on title. That's the big difference. So the only difference in that perspective between my mortgages and Tomekia's mortgages is that my loan balance is going to go up because you don't have to make payments, and Tomekia's is going to go down. But the loan balance has to be paid when the home is sold. It's that simple. The other concern is the kids will lose all their inheritance and will have to pay off the loan. That's not true. I'll deal with that in a little bit. The other myth is if my loan balance gets larger than the value of the home, we will be thrown out on the street. Right there in the paperwork with reverse mortgages is you are guaranteed that you can stay in your home until you're 150 years old. It's right there in black and white. So what they're really saying is when you do a reverse mortgage, you do not have to leave the home or pay the loan balance until, if it's a couple, the last of the two of you are no longer living in the home. So typically, when we do a reverse mortgage, there's plenty of equity left in the home. So typically, when the home is sold, we get paid, and whatever's left over will go to the seller. And that's quite often the kids. But if my borrower lives for a long, long time and the real estate market has flattened out or either gone the other way, there's a chance that the loan balance may be higher than what the home's actually worth. Well, in that case, the mortgage insurance covers the difference. In other words, you can never, ever owe more than zero on a mobile home. Like there was a fellow that passed away in South Dakota at 116. If I'd loaned him 200 grand when he was 62, God knows what his balance would have been. But when the home was sold, they didn't owe any more than zero. So that's really important. So, and the other one that people worry about is they say, is it going, this is a lot of money you're throwing into my retirement budget. Is this going to impact Social Security? Not only does it not impact Social Security, I always tell people, and a lot of people love to hear this, and that is a reverse mortgage is none of the IRS's business. This is all tax-free money. So if we go to, so what the heck is a HECM? So people we'll hear about HECMs. They will, some people will market reverse mortgages at HECM as HECMs. It's really straightforward. HECM is FHA's term for what everybody else thinks is a reverse mortgage. It stands for Home Equity Conversion Mortgage. I unapologetically market my loans as government insured reverse mortgages. I think some people who try to tell people they're going to put them in a HECM, at some stage the customer is going to say, well, this sounds like a reverse mortgage to me. So, what I do is explain that we're going to do a reverse mortgage. It's insured by the government and there's nothing to be concerned about. The thing that's given us the black eye is this thing called an equity share loan. And this was very, very common back in the late 80s, which for a lot of my demographic doesn't seem that long ago, right? And the equity share loan, that was when a lender would loan money, and they still do, some of these private money guys, and they go on title with the customer. So now they become a part owner. And it's because of that, people worry that that's what we're doing with a reverse mortgage. So the really, really important difference is an equity share loan, the lender becomes one of the owners. On my loan, all I do is I put a lien against the home, just like anybody does with a mortgage. So if you don't get anything from today, please understand that, because that's really important. And that's the reason a lot of people who could be living great don't do a reverse mortgage, because in the back of their mind, there's something's not right about it, right? So if we've got a reverse mortgage, the home equity conversion mortgage is the only reason I use that term is that that's the government's product. Okay, and to use the government's product, you have to be 62 or older, or in the situation where there's a couple, one of the couple have to be 62 years or older. So what it does, it enables you to convert a portion of your equity in your home into real money. All right. And so what we'll do is we're going to, and I'll explain in a minute how much, but we're going to write a reverse mortgage and we're going to distribute those funds in terms of good old-fashioned cash, an appreciating line of credit. They can get monthly payments or they can get any combination. Whenever I'm talking to one of Tomeka's borrowers, we try and figure out what combination will work best for them. All right? That's why it's kind of neat that we have a specialist division, because there is no one way to write a reverse mortgage. It's kind of the other way around. You tailor a reverse mortgage to the people that you're working with and structure it what's best for them, not what's best for the lender. All right, so purely and simply, a reverse mortgage, the bank loans money and collects the loan balance when the home is sold. I always include that slide because it's really that simple. The bank's going to loan you some money. No, we're not going to give it to you for nothing. We charge interest. That's our business model. But we want our money back, and plus the interest when the home is sold. When that happens, we get our money back plus the interest, and whatever's left over goes to the seller. That could be my borrowers just moving somewhere else. But quite often the seller is the heirs. But purely and simply, I don't need to get paid. I need to get paid once. And when I say I mean Cross Country Mortgage needs to get paid only when the home is sold. So when you're no longer living in the home, you got to tell us or tell HUD that we're moving, or my mum just passed away, and you've got 12 months to sell the home. But there's no point dragging your heels, because it's a reverse mortgage and every month the balance goes up, right? So, if that happens, realtors call me all the time saying, hey, my home's got a reverse mortgage on it. What do I do? And I'm like, nothing's different. Just call and get a loan balance and you got to pay off whoever is leaned against the property. All right. So how much can I get? The amount that you can get is called principal limit, and it's real simple. We're going to calculate how much you can get based on your age, the value of your home, and today's interest rate. The older you are, the more money we're comfortable loaning you, and vice versa. Like a 65-year-old right now on a $500,000 house is going to get not even 200, about $180,000, $190,000. A 101-year-old, a loan that I did last year in San Francisco on a $500,000 house, she's going to be able to borrow about 400. And can you see why? Because the younger the person is, the more equity they leave with the homeowner, because even though we cover negative balances, we can only afford to cover so many of them. So the older you are, the more money I can loan you. Hold on to this calculation in the side of your head, because this is the same calculation we use when we decide how much a person is going to have to put down when they use a reverse mortgage to buy a house. All right, so we won't worry. There's out-of-pocket fees. We'll move quickly through that. The fees are all financed except for the appraisal fee, which we typically try and collect, although I will put that into the loan. If anybody talks reverse mortgages and talks principal limit, they're just talking about the amount that they can get from a reverse mortgage. And once again, cash, line of credit, monthly payments, or any combination. All right. Now, one thing that's kind of neat, and then we'll move on to purchases here, but one of the features of a reverse mortgage is called the line of credit. Now, I've chatted to Tomekia about this. A lot of lenders, every industry has their rogues, right? We get paid on how much a customer actually borrows at closing, but you should only really borrow what you need, and whatever you don't need, just leave it in the line of credit, because the line of credit is not charged any interest. If you have a $150,000 line of credit, none of that is charging interest. That's just your access to money. So let's say, for as an example, we had somebody living in a $600,000 house, and I was able to loan them $250,000. So they borrowed $100,000 cash, and they used that to clear their mortgage. So now they have no mortgage payments, but they didn't need any more money. So I convinced them, let's just open a reverse mortgage line of credit. You can grab the money tax-free anytime you want, and interest only gets charged on what you borrow. But more importantly, and this is why your financial advisor friends will be interested to hear from you, talking to the loan officers right now, is because this line of credit has become the darling of the wealth management community, and I'll show you why. So here's my customer with access to $150,000. And in the first year, they didn't take out any money. In year 2, they bought a new car for 20 grand. So obviously the new car was a used car, but I'm just making it up as I go along here. All right. And then we've got the new car that they bought wasn't so new, had a blow-in transmission. That cost 6 grand. Now, in a lot of people's houses, to come up with 6 grand to fix a car is problematic. It's a lot of money. It's typically a credit card event. In my situation, my borrower would just take it off the line of credit. And then they, no withdrawals. Then they went ahead and they decided to take the family on a cruise for 25 grand. The following year, they decided to do some renovations in place to help age in place, no withdrawals. 30 grand to help the kids with their college tuition. And then I've got year 9, a whole bunch of repairs that needed to be made for a total of $125,000. Now, the reason why the wealth management community likes this product so much is that the available balance, in other words, that portion of the line of credit that you haven't used, actually increases at the contract's interest rate. And why does it do that? It keeps up, because remember I said before, the older you are, the more money you get. Well, what it's saying is this is money that you have access to, but you didn't get it. So we're going to let that increase as you get older and as your home becomes worth more. So here's what's kind of neat. They had 150 over this 10-year period. They borrowed $125,000 off the line. So you would think that there'd be $25,000 left, right? But no, in reality, because the money that you hadn't borrowed, that because of that, the unused balance continued to grow. They really had, and I did this with this morning's rates. I did it for you guys. If somebody took out a 150 line of credit today, spent $125 in those increments that I used in my example, their actual line of credit today is $131,635. Pretty cool, huh? So when somebody says, gee whiz, I'm 65 and you can only get me $180,000 on a $500,000 house, I'm like, I can open up a gold mine for you. Just take what you need to clear some credit cards and leave the rest in a line of credit. And the longer you leave it alone, the more it's going to grow for you. But that's pretty darn neat. You got 150, they took 125, and what, $19,000 only has come down off your line. So I'm not, if you were all financial planners, we'd go off on a tangent now for about half an hour, but I'm not going to do that to you. You'll be relieved to know. All righty. So this is a quote I like from an economist. What if you were told that your client could convert a portion of their home's value into a reserve fund that had a built-in, guaranteed, tax-free minimum growth factor that couldn't be frozen, canceled, or reduced and could be accessed anytime in the future, regardless of the home's value or your client's income, assets, or credit? What would you say? What he's saying is that this is a contract that's guaranteed by the government. The available balance is guaranteed to grow no matter what's going on with real estate, the stock market. So this economist is obviously a fan, but I can't afford him to come and speak to us, so I just figured I'd use one of his quotes. All right, moving quickly on. All right, now we're going to talk about why you're here. So, has anybody ever used a reverse mortgage or been involved in a transaction where a reverse mortgage was used to buy a home? I can't see anyone, so I'm just assuming no. All right. So, yeah, you can use a reverse mortgage to buy a house, and this product is, I'm going to send you all a video from the Housing Wire as a follow-up that I want you to watch, but this product is truly a product that offers realtors all sorts of potential, and I'll show you why. So we've got a reverse mortgage, and here's the senior's current home. And in this home here, remember I mentioned every year we've got 10,000 seniors, 20,000 knees, 20,000 shoulders, 20,000 ankles. The point I'm trying to make is that people don't manage stairs as well as they did when they were young. So in this house here, let's say the 82-year-old husband is down here watching football, and then he remembers that he forgot something, which is up in the bedroom. Well, that's a journey, right? He's got to get up 2 flights of stairs on wobbly knees and what have you. They would far prefer to be in, a single living, this home here, close to the golf course, close to the community has a pool for the grandkids. You get the idea. So, to right size from there to there for a lot of people is a big, big deal. Why don't they do it? First of all, they don't know that reverse mortgages for purchase even exist. And secondly, they don't think they can afford to. So I'm going to use one scenario, and I'm going to take this couple through the reverse purchase journey here. So here we are here. So we've got a home valued at $720,000. This is a retired couple. The home is valued at $720,000, but they still have a $300,000 mortgage. Let's say these guys are in their, let's take a look at them. They look pretty sprightly. Let's call them early 70s. A $300,000 mortgage is pretty much a payment for the rest of their life, or certainly a good portion of it. And a monthly payment, mortgage payment in retirement is a real burden on the cash flow. So these people can do one of two things. I could come in and do a regular reverse mortgage we could pay it off and they could live in their home with no mortgage. But they also don't like the home. It's too big. It's too far away from the grandkids. So if we've got a $720,000 house and we've got a $300,000 mortgage and they sell the home and they want to buy a home for cash, what are we looking at? We're looking at, I just rounded up or down to realtor fees of $40,000. So they sell it for $720,000. They pay the realtors and everybody, and they net $300,000 only. Okay, so now the realtor has to go out and find them a home for $300,000, which typically means in a lot of areas they're showing them a townhome or certainly a much smaller single family home. So here's what they would do. They would go ahead. The realtor finds them something for $300,000. They pay $300,000. The great news is that they're now in a house, but they don't have to make mortgage payments, but they've had to downsize quite a bit. So let's first of all look at what a reverse mortgage would look like in this particular situation. Okay, so that's what I meant. They've got funds remaining $380 after. Okay, let me start again. Sales price $720, $40,000, pay off the mortgage, $380,000 left over. Okay, here we go. So now they're looking for a $380,000 home. Now, if they bought the $300,000, $80,000 home with a reverse mortgage, it would look like this. Because what I did is I used the same formula. I used the 380 as the value. I plugged in the date of birth of the younger of the two of them, and it shows me that based on a $380,000 home, today's interest rate and the age, remember they were my three variables, that I can loan them $170,000. So what they have to do is they have to come up with a down payment of $210. All right, so why would they do that? So I wrote a reverse mortgage of $170. They came up with $210 down. So the net proceeds is $170, but so of their $380, they're living in a $380,000 house. They have $170,000 left over. But remember, why did they want to pay cash to begin with? They wanted to pay cash so they had no monthly payment, right? Well, this is a reverse mortgage. How much do you have to pay every month on a reverse mortgage? 0.00. So these folks, when the dust settles, they've got out from the old home, they've got out from that $300,000 mortgage. Now they're living in a $380,000 house with no payments, but because they used the reverse mortgage to purchase, they actually have $170,000 sitting in their check account. Okay, now I'm going to show you the one that realtors can make, the scenario where realtors can make a ton of money if they understand how to market this product.
I got one quick question, Mr. Stewart.
Yep.
The net proceeds from the sale, the 380, is that when the homeowner is basically selling it back to the bank? The 380.
Okay, great question. So what I'm saying there is that if they wanted to buy a $380,000 home using a reverse mortgage for purchase, based on a $380,000 home and based on their age and based on today's interest rate, I can loan them $170,000, okay?
Okay.
So on the $170,000, I'll loan them $170,000. I've created a reverse mortgage and they don't have to make any payments on that. So if they put another $210 down, now they've paid for the $380,000 home, okay? The proceeds I'm talking about that's the amount of money left over from the 380. That's sitting in their checking account.
I think she's saying, how did you get to the 380? And that was from when they sold the two-story home.
Yeah, so if we go back here. So they sold their house at $720. They paid a realtor. They paid off that $300,000 mortgage. So they had $380,000 left cash.
Okay.
And the realtor knew that they were going to only have 380, so she had found them a $380,000 home. The only thing I'm trying to point out here is, yeah, they could have bought it with cash, but that would have wiped out every dollar that they got from the sale of the home. All I'm saying is if they used the reverse mortgage, they would still be in that $380,000 home with no payments.
Okay.
But because I only needed 210,
Mm-hmm.
they've got $170,000
Oh, okay.
left
I'm
over
fine. I
from the
got you
sale of the
now.
home.
So Richard, this is Angela.
Hey,
So
Angela.
I just want to jump on what Phaedra was saying, just to make sure I'm clear as well. So basically, the first house, the two-story house that they're selling, that they originally had, what you're saying is that there was no reverse mortgage that had anything to do with the first house, right? With the two-story house.
That's
They
a great
buy-
point. No, this is just a normal scenario that you run into every other day.
Correct. So then when they purchase the second home, they use their proceeds, they pay cash. And then essentially they are taking out a reverse mortgage on the second house.
No,
on the house that they
that's a
bought.
great point. So in 2009, the feds voted in this reverse purchase because what people were doing is they were going ahead, selling their home, and then using Tomekia to find them a loan to buy the home, knowing they were going to do a reverse mortgage anyway, and there were two sets of closing costs. So they approved and the reverse mortgage for purchase because it enabled them to sort of purchase the home and do a reverse mortgage at the same time. Is that
Okay, so specifically then this scenario, so like if you go back another slide where you had the couple on the picture. So where you say where it says right sizing with reverse mortgages, this scenario is really purchasing with reverse mortgages.
Yeah, downsizing. Somebody just told me the new term is right sizing.
No. But I just mean for us as we, as most of us, I believe on the call are realtors, right?
Yeah,
And so
perfect.
for us, just trying to figure out the wording that we would use. So yeah, I understand right sizing or downsizing, but the goal, the truth is this is a purchase with a reverse mortgage.
Using a reverse mortgage to buy a home. I'll tell you what, Angela, let me go into the second scenario.
Okay,
I
I'll shut up.
think
No, no, no,
I think I got where she was getting confused at. So basically, Angela, the first scenario was if they just sold it the regular way. So he was saying that he can give a homeowner the same $380,000 without them selling it. They can get the same $380,000 and keep the property, and they only need 210,000 of the 80,000. I mean, the 380 that he given them on the reverse mortgage, and then the rest of it, which is 170, will be sitting in their account, and they'll have two houses then. But
No.
right?
No, I think, and that's kind of what I'm saying. There's when he started on this page, he's following up through one scenario. But I'm saying that what he is explaining, I believe, is that they are doing a reverse, they're purchasing that second house with a reverse mortgage at that time. So it's like it sounded like he was talking about two scenarios. Then when he got all the way through, I was like, oh, this is all one story. That's so I could be explaining that incorrectly.
Purchase. So he was sharing with you what they could do with just a normal cash purchase. They could buy a $380,000 house and walk away. Or instead of doing a cash purchase with those proceeds, they can do a reverse. And so now you're going to hear the second scenario of how you can even make more money using the reverse in the same family, but scenario number 2.
Yeah, all I'm saying here, Angela, is that the realtor had already found them a house for 380 because she knew that was what they were going to net from the sale of the home, right? Because hopefully you're getting both ends of the deal here, and you were listing their first home for 730. You knew they had a mortgage of 300. You knew that they only wanted to pay cash for a home because they didn't want a mortgage payment. So that limited you at trying to find them a home at 380 or less because that's all they had. So if they wanted to buy a home for cash, they were maxed out at 380. What I'm saying is if they decided to buy that 380 home with a reverse mortgage, they could buy that home. But if they came and saw me, I would write a loan for that. So if they put down 210, they'd be living in the home that you already found them with no monthly payments. But the good news is in this situation, they didn't have to spend all 380. They only had to spend 210, which left 170 grand at the closing table. Let me move on to the next one. I think it might come together, and maybe it won't. And then all I have is time to try and help you guys out. Believe me, sometimes I confuse myself, so don't worry. Okay, so in the more common scenario, you guys, I'm sure as realtors, you've never had somebody coming up to you and wanting you to show them homes that they can't afford. I'm sure that's never happened, right? So what typically will happen is you'll show them this and they'll go, oh my God, it's perfect. It's close to the golf course. There's a swimming pool over there that the grandkids, thanks for showing it to us, but we've already told you we just can't afford or don't want a mortgage in retirement. And we also told you we have $380,000 to deal with. This home's $675,000. We just, thanks, but no thanks. It would be a dream come true, but we don't want a mortgage no matter how small. So, like you may, in this situation, you might say, well, go and see Tomekia. She'll loan you, the other 300, and they'll be like, you're missing our point. We just got out from under a $300,000 mortgage. So here's what happens here. And this is where the product for realtors is just fantastic. So let's look at a $675,000 home. What I do now is I figure out based on that 675, based on their age, based on the rates, how much am I prepared to loan on this home? And so it looks like this. They've got the net proceeds from the sale of their home was 380. Everybody with me so far? And now I've got a new home that you showed them at 675. And all you have to say is, if I could get you into that 675 home with no monthly payments, is that something you'd want to buy? And they would be like, well, of course. And this is based off a real-time scenario that I did a few years ago. All right. So it's like, yeah, we love the home, but we don't want mortgage payments. And as you know better than anyone, all we have is 380. And then you say, you don't try and sell a reverse. You say, I'm going to set up with a meeting with Tomekia and Richard, and all that I ask is that you listen to them with an open mind. Because as a realtor, all you have to say is reverse, and that'll be the end of the deal. All right, so based on a $675,000 home, and based on the age of the younger of the two of them, I can write a reverse mortgage for $305,000. What's the payment on that mortgage? 0.00. It's a reverse mortgage. So I've created a reverse mortgage that is going to be paid one day when they sell this home. So to make up the difference, they're having to come up with 370, right? Well, they got 380. So when the dust settles here, not only did we get them into this beautiful dream home for $380,000, they even had $10,000 left over. So just to back up here, I'm going to go through this one more time because it's really important from a realtor's perspective. Okay, so they look at the home and you say, if I could get you into that with no monthly payments, is that something you'd be interested in? They go, oh my God, what's the catch? And then Tomekia and I speak with them, get them comfortable with the idea of the reverse purchase. And this is what the closing is going to look like. They're going to move into that 675 home. They've got 380 sitting in their checking account. My new home is at 675. The seller is going to get one check from me for 305. They're going to get one check from your borrower, or I'm sorry, your client for 370. The two of them add up to those two checks add up to 675, and my customer is going to move into that house and still even have $10,000 left over from the 380. Does that follow?
Yes.
I understand if it doesn't. I'm giving you a glass of water with a fire hose here, probably two fire hoses.
So when they sell it, they owe if they sell it, they're gonna owe somewhere around the 370 that you contributed?
But when they sell this house?
Yeah, if they were to.
Yeah. So if they were to sell this house, there's going to be a loan balance against the house, and that's going to be my reverse mortgage. If they stayed in there for only a year, well, the reverse mortgage balance is only going to be like 315, right? If they stayed in there for 10 years, the reverse mortgage balance now might be up to, let's call it 500, but also the home's probably appreciated up to 800 or 900.
Mm-hmm.
But whatever happens is, and remember when we first started chatting, I mentioned how cash flow is king in retirement. Trust me on this one, the most important thing on their mind is that they're living in this house, and from a cash flow perspective, they don't have to make any monthly payments. In fact, they're in exactly the same situation as their neighbor who paid $675, right? From a cash flow perspective.
Mm-hmm.
Because it costs them $370. What I do is, if you have somebody who's interested in a reverse purchase, all you have to do is give me their age, and I tell you what their down payment would need to be. Like in this situation, I would tell you very quickly, you give me their age, and so I run some quick math, and I say, well, they're going to need to put down 370 divided by 675. So they're going to need to put down 55%. So pretty much no matter what, when I say pretty much, no matter what home you show them, these people, you just say, look, I can get you into that home with no monthly payments with 55% down. Now, if they were in their 80s, it would be more like 43, 44% down. If they were in their late 90s, it would be like 20% down.
Gotcha.
So I'm going to go back through them one more time. So we did, here's our couple. They live in a $720,000 home. They've already decided it's too big, too far away from the kids. The yard's too big. But as importantly, they've got a mortgage on there that they really would, has become burdensome. So that's our couple. You meet them as their listing realtor and you say to them, look, we can get you out of this. What we can do, this is before you met me, what we can do is we can list your home. Let's get everybody paid, including the realtor, and you will have $380,000 to go shopping with. I have homes in the area for $380 that you might be quite happy in. Probably a townhome, but still everything you're looking for. So you show them $380,000 homes, and they have the mortgage gets paid, you get paid, and they have $380, and you use that $380 to buy a house for cash, deal done. You've probably done 1 million of those. What I'm saying is, in this particular situation, they could still get a home for $380 and still have no monthly payments, and all they would have to do is put down $210 net proceeds. And so that way it's like, we got you in the house that I'd already found you. But the neat thing is, what's going to happen is when the ink dries on the contract, you're still in that $380,000 home that we found you, but rather than having nothing left over from the sale of the home, you've actually got $170,000. 170 grand. Well, it's a lot of money anyway, but for a lot of retirees, I mean, that's the lottery. That's a lot of money.
So Richard, can you hear me?
Yeah, loud and clear. Sorry.
So the reverse mortgage is done on the two-story home.
So in this case, I don't have a picture of the 380 home. I probably I got to add a slide. Sorry, Jamance. So the two-story home is the one they live in right now.
Right, and that's the one that we're going to do the reverse mortgage on.
No. Well, no, this is the one they're going to sell. We're going to do a reverse mortgage on the one they buy. Because
So
and
they
that's a great
buy it
question because
first and then do the reverse mortgage?
so
Or you do the reverse mortgage as the sale?
yeah, it's called so it's a bit. I get where you're coming from because 90+% of reverse mortgages are reverse mortgages that are done on an existing home.
Right.
This is a variation of a reverse called a reverse mortgage for purchase, which means you're actually using a reverse mortgage to buy a home. So you've got let's just call them traditional reverse mortgages. Then you've got reverse mortgages for purchase, which is another product.
So I guess,
And it's
so they
just
still own two homes.
no, because I need the down payment money, and that typically comes from the sale of the home.
So that's what I was
Okay.
saying when I was, Jermaine's about like the title of the slides are kind of misleading. Because we keep thinking, and sorry for Richard, but I was struggling with this too, and I think we struggle with the same point.
Okay.
We're so busy focused, we know so much reverse mortgage to his point in place. The word that we're trying to learn today is reverse mortgage purchase. So there's some name that he's describing that's different from this kind of reverse mortgage in place that everyone is kind of familiar with, where they're drawing from their own house. But what I'm believing we're learning today is that no, you can use a reverse at purchase. And so then at purchase, they're getting essentially that money because that new house becomes their in-place house, if that makes sense. That's how I'm explaining it to myself.
No, and that's a good way to do it. The term I always use and what most people in the industry use is a reverse for purchase. So and when you talk about reverse for purchase, is I'm going to buy a home and I'm going to buy the home using a reverse for purchase. And the reverse for purchase is simply the amount of money that I'm prepared to throw into the deal. And that is, once again, depends on how old my borrowers are and how much home they're looking to buy.
Okay, so we're still selling the two-story home for $720, paying off the 300,000 mortgage, but then we're going to purchase the second home with a reverse mortgage.
So let me jump in. All this transaction is done is hopefully you listed the home, so you got paid on the transaction. But from my perspective, all this transaction did was provide them with the money to put down on another house. So this house is sold. My reverse mortgage, the reverse mortgage is not involved in this home. The only reason I bring that up is that most people, you have to come up with a huge down payment, and it typically comes from the sale of the property. Remember, this is just one scenario. More often than not, they have no mortgage. But I was just trying to use a scenario where the advantages there was more than one advantage. The advantage here was they can get more home using a reverse purchase, and they also can get out from under this mortgage. So let me go through it one more time again. So I'm going to say that let's put the scenario let's make this a real life scenario. You're the listing realtor here, excuse me. You've got the home under contract for 720, and so you got the home under contract for 720. Let's leave it at that. And then we got to this part here. The sales price was 720. The realtor's expenses was 40,000, and the mortgage was 300. Now I'm just rounding numbers here. I'm not doing it to the penny or anything like that. I'm just trying to talk in general terms. I've got a sales price. You sold the home at 720. Your commission was based on a 720 sell. From the customer's perspective, once they paid the realtors, once they paid the mortgage off, they were left in their checking account with $380,000. That transaction is done. So put that to one side. Now it's like, well, we've got to live somewhere. What are we going to do with the 380 grand? Typically, they'll say, look, we just don't want a mortgage. Could you please find me a home for $380,000? So in this particular scenario, you were able to do that, and you found them another home for $380,000. All righty? So far, so good?
Yes.
Okay. So now you hadn't even met me, or, Tomekia hadn't even talked to you about reverse mortgages. So what you would have ordinarily done is found them the home for 380. They would have paid cash. And the good news is now they're living in a home with no monthly payments, but they've also had to spend every last dime of their 380 to get into the home. All I'm saying is, if they'd done it using a reverse purchase, to sort of break it down, if they'd done it, I guess the easy way to look at it is, if they'd done it with a reverse mortgage, I could have kicked 170 grand into the purchase, but they don't have to pay me until I'm sold, until the house sells. So from their perspective, they got into that home that you had already sold them, but they got into that home rather than spend all their 380. If they'd done a reverse mortgage, they would have actually had $170,000 left over from that 380. But I really wanted to spend more time on the next one, because the next one highlights. So now we've still got these same people, but this highlights really how you can use the reverse purchase to help your buyers buy more home and still have no monthly payment, right? So the reason I ran this scenario past everybody is, they look at a $675,000 home, but it's not in their budget because they're only working with 380 if they don't want to pay extra and have a mortgage. And what I'm saying is using the reverse purchase on this home. So forget about the 380 home. We've moved on to another scenario. So in my second scenario, let me just get your photos out of the way. In my second scenario, we've got the net proceeds of 380. So remember they had 380,000 is what they know they're going to get when you've sold their home that you've listed. So they sell that home, they know they're going to get 380, because this can all be done well before the home's sold, obviously. So they've got 380. As far as they're concerned, if they don't want to have a monthly payment, all they can spend is 380. What I'm saying is, with a reverse mortgage, if they wanted to buy a $675,000 home, I can kick in, so to speak, $305,000. So they'll only have to come up with 370, which means 380 is more than enough to get into the 675 home if they don't want to have monthly payments, and then they even have 10,000 left over. So let me go through that again. So here's a home for 675. They would love to get it, but they know that when the home that they're in is sold, they're only going to have 380. So you haven't even sold them, shown them homes like this because they said all we can afford is $380,000. But if they're on board with a reverse purchase, well, now they know they can get a home up to, in the high sixes. So the way they could buy this home without any monthly payments is they've got the 380 from the sale of the house. The home's 675. So based on their age and based on a $675,000 home and based on today's interest rate, I can loan them $305,000. So I'm gonna loan them $305,000. They owe me that back plus interest, but not until the home is sold. So this doesn't require a monthly payment. Now they need to put, I think we said 55% down. So the 55% down on a 675 house is 370. So what I'm saying here is that 380,000 has got them into a $675,000 home, and they still don't have monthly payments. So as a realtor, it just enables you to sell them so much more home. If someone says, look, we don't want to spend more than 380, and you say, well, why is that? And they just say, look, we want to pay cash because we don't want to make monthly payments. It's like, well, is it the monthly payment thing? Is that the important thing? Yeah, no monthly payments. Well, there is a way where you could still have monthly payments, but I can start showing you homes around 675, 685. How could you possibly do that? And that's when we talk to them about reverse purchases. And when the dust, I got to tell you, and I know it's hard to grasp, and I know my presentation should probably be better, but when you're at one of these closings, it's such an exciting room to be in because you've got your borrowers who thought they were going to have to spend 380 or less are now closing on a $675,000 home. They're thrilled. The realtor's thrilled. Their commission just doubled. And, I've closed a lot of reverse purchases. So every time I do one, the atmosphere in the room is just fantastic. And then the advantages are quite straightforward. And that is, so HECM, as I said, is reverse mortgage. A reverse mortgage for purchase, these are some of the advantages. The buyers spend less money out of pocket, but can afford an upgrade. Like I showed you with that house. At 380, they actually got a 675 home and still didn't have any monthly payments. It allows retirees more options. Obviously, if you can afford, if you only have to put 55% down on something and live there with no mortgage payments, obviously it gives you a lot more options. In that first scenario, rather than spend all 380, they were going to have $170,000 left over. That's a big deal. That goes back into their retirement. And obviously there's no monthly payments for as long as you live in the home. The loan balance is due when the last of the two of them are no longer living in the home. And
So a resized reverse mortgage is a HECM. It's
yeah,
a home equity.
a HECM is the government's term for an FHA reverse mortgage. So if you say a HECM for purchase or you say a reverse for purchase, it's exactly the same thing. It's like calling me Richard Stewart or Rich Stewart. It's the same thing.
So the answer is yes.
I'm sorry. Yeah, the answer is yes.
A resized reverse mortgage is a HECM.
Correct.
And a HECM is owned by the lender, not by the homeowner.
The HECM is just a mortgage, so I guess
Yeah, it's the type of loan that the homeowner is getting, basically.
Right, but earlier in the over 40 minutes ago, he said that a HECM is the lender becomes the owner.
No,
I
Yeah.
think so.
it's just a mortgage.
a lot-
It's just a mortgage.
just a normal mortgage, and some of
Yeah.
them are just like catch terms or terms to kind of keep current. Like any right size could mean think different for each person. But if you
Mhm.
look at it as like, if I look at my parents per se, or my neighbors that are 80 something years old, and they're already in a one-story home, but they don't want to leave. So if they need to have around the clock care because their children live way far away, which they truly do, they could take a reverse mortgage out of their current home and start either a check a month so that they have money to pay, or they could get a lump sum or just nibble off of it as they needed to and stay in their one-story home. Or the flip side, they could sell it, take $800,000 cash money because they don't have a mortgage, and they could take that money, still decide to keep a portion of it and invest a little bit of it into the reverse mortgage and go buy in a full-on adult living type community, maybe up in Austin or something like that. So it's just another option for more senior people to be able to purchase in this new appreciated market that we're all living in. It's just and the main goal for the realtor is really just to do the introduction, and then allowing I can give a quick overview of how it works, to try to answer any of the myths that are out there that they have known about it, but to let Mr. Richard, speak to them in terms that would be understandable to them.
So I
And
think,
I think also we tried to cover an awful lot of ground there
Yeah.
in the space of 40 minutes or so. So we went from the need for reverses, and then I really did want to talk about that line of credit feature, even though it doesn't apply to purchases. But I have to apologize. I think I bit off more than I should have chewed, because we went from the history of reverses to the da-da-da-da, then to the line of credit, and then bang straight into purchases. So if I was sitting on your side of the table, I would have got turned around as well. I'm going to make it up to you, though. I'm going to get you some material that I think will do a much better job of breaking it down. I just feel that there's so many important points, and it's kind of hard sometimes to do a presentation and not touch on all of them, even though I should probably discipline myself to not do that. But it depends on my audience too. Like I'm talking to loan officers and realtors, but you also have relatives and parents and people like that. You know what I mean? So 1 out of 10 reverse mortgages in a pool of loans is probably a reverse purchase, and the rest of them are reverse mortgages on their existing property. And it's hard to separate the 10% from the 90% in terms of how the products are a little bit different. So the last thing I wanted to do was jump on a Zoom meeting and turn you all around upside down and inside out. And I apologize if I've done that. But if you can, please don't give up on me, because as a realtor,
No, you did. You brought it back around, because I think at first for me, I was thinking 2 properties, but I figured out what you're saying. You can sell your property and then get a new loan, a new reverse mortgage loan, basically,
right.
and buy another property, probably the same property for the same amount, just you won't have a payment,
And
and
I'm
you
going
might
to
have
take you
some
on the
money
road.
left
That's
over.
exactly right.
So I got it when you brought it back around.
Yeah,
Mr.
the
Stewart,
first,
on
the
again.
only reason I spend any time on the first transaction is just to explain that that's where the money comes from. And I just use that as an example of, well, people will say, well, where's all this down payment money coming from? Well, in that first example, it's like not only is it coming from the home, at the same time they're getting rid of a mortgage that they'll probably never pay off. Sometimes, quite often in these purchases, the departing home has no mortgage on it. So in that example, let's say they had a $700,000 home with no mortgage. Well, shoot, they could use $550,000 and get into $1 million property and still have no monthly payment. So it just gives them a lot more buying power. I'm going to send you this 3-minute video, which I pray you all watch, because he gets pretty excited about it. It's and the only reason I really hope you hang in and try and, grasp it a little bit is that I do have realtors who are doing really well with this product because it's the only product I know that can create listings from people who weren't even thinking about selling their property. Like these people, imagine if you are talking to the people in our scenario in the $720,000 house with a $300,000 mortgage, and you're effectively saying, I can get you out from under this house and your mortgage and into the $675,000 house and still have no monthly payments. They look at you like you're nuts. But that's what this product will let you do.
I think you did good, Richard. For me, it was lack of knowledge because this is my first time having a detailed conversation about reverse mortgages, and I was under the impression that you kept your previous, your existing home,
Right.
and did. So I got what you're saying now. You all right?
Yeah, you did a great job. I think for most
Good.
their first time really hearing so much about it, and it could be that we need to just have you on again, because knowledge is power, and understanding, it's so important in our community that we're serving. A lot of people don't have the information, and it gives them fear when they don't have the information. So
Yeah.
the more we hear about it, the more we kind of walk it through. I like to talk in apples and oranges. I'll use Legos if I have to,
Well,
because
we just crammed a 2 CE course
yeah, we
into like
did.
45 minutes.
They
So,
need some certificates, brother. Give them
I
some.
just, hey, I
but
just have one quick question, unless I missed it, because I did join a little late. I don't recall seeing or hearing anything about a credit score. Does that factor into this?
There you go. That's a good question.
great question. Yeah, it does. I'm going to answer your question in 2 bits. The first thing is there is a underwriting requirement for reverse mortgages. There never used to be, but in 2015 they changed that. I will say it's a heck of a lot easier to get my people approved because I don't have to put a mortgage payment in the math. So very rarely do I lose loans because of debt ratio, but they still have to have relatively decent credit. The 500s is going to make it really tough, but typically if somebody's 620 or better, I can get them approved.
Okay, thanks. I know we're over. I just want to understand that quickly.
No, I'll stay here all day if whatever it takes.
Y'all are so amazing. Anyone else have any questions?
No, I look forward to receiving the video and then,
We're gonna post it on the YouTube channel. So it'll probably be tomorrow. I try to cut the front part out when we're waiting for people to log in, and then
okay.
register.
So are you talking about the video from Housing Wire? Because I'm definitely going to send that over.
The one that you said you were gonna send
Yeah,
us.
it's fantastic. This guy does a much better job, I'm ashamed to admit. But
And it's 3 minutes, huh?
yeah, that's all he has to do. See, when you think about it from my perspective, I mean, what part of that do you leave out? Because if I go straight to the purchases, you guys are going to say, well,
What about the
decide
kids?
how much money they get,
That's true.
So
That's true.
And then I look forward to the another session with you, Richard.
yeah,
Because
absolutely.
it'll make more sense to hear it again.
We'll get it scheduled.
Yep, let's do that. And I'll see you in a couple of weeks, Tomekia.
All right, brother. Thank you all.
Thank you, Richard.
Thanks so much for your time, everybody, and thanks for hanging in there.
Thanks,
Absolutely.
everyone. I'll be sending that video link once it's ready to go, okay?
Okay, see
All
ya.
right, thank you.
You're welcome.
Bye, everyone.
Bye-bye, honey.
Bye-bye.